Futures contracts occupy a strange place in the investing world. They are everywhere and nowhere at the same time. Futures quietly set prices for commodities, currencies, interest rates, and equity indices that shape the global economy. Yet most individual investors only encounter them through warnings about leverage and risk. This split perception leads to confusion. Futures are often dismissed as instruments for speculators or professionals, only when in reality they were created for a far more practical purpose, transferring risk from those who cannot afford uncertainty to those willing to bear it. At their core, futures contracts are agreements to buy or sell an asset at a predetermined price on a specific future date. The asset could be oil wheat, gold stock indices, interest rates, or currencies. Unlike stocks, which represent ownership, futures represent obligation. When you enter a futures contract, you are committing to a transaction in the future, not purchasing an asset outright. This obligation is what gives futures their power, efficiency, and danger. The original role of futures was hedging, not speculation. Farmers wanted to lock in prices for crops before harvest. Airlines wanted to stabilize fuel costs. Manufacturers wanted predictable input prices. Futures allowed these participants to plan, invest, and operate without being at the mercy of volatile spot prices. Speculators entered the market later, providing liquidity and assuming risk in exchange for potential profit. Understanding this origin is critical because it explains why futures are structured the way they are: standardized, leveraged, and unforgiving. One of the defining features of futures contracts is leverage. When trading futures, you do not pay the full value of the underlying asset. Instead, you post a margin, a small percentage of the contract's notional value, as a performance bond. This allows large exposures with relatively little capital. Leverage is not inherently bad, but it is inherently amplifying. Small price movements translate into large gains or losses relative to the margin posted. Futures do not slowly educate mistakes. They highlight them immediately. Another key concept is daily settlement, also known as mark-to-market. Unlike many investments where gains and losses are realized only when positions are closed, futures positions are adjusted daily. Profits are credited and losses are debited at the end of each trading day. If losses exceed available margin, additional funds must be posted or the position is closed. This mechanism reduces counterparty risk, but increases behavioral pressure. Futures demand constant accountability. There is no hiding from losses and no delaying recognition of error. Standardization is what makes futures liquid and efficient. Contracts have fixed sizes, expiration dates, and specifications set by exchanges. This standardization allows participants from around the world to trade the same instruments with confidence in execution and pricing. The trade-off isn't flexibility. You cannot customize a futures contract to your exact needs. You must work within the structure provided, adjusting position size and timing accordingly. Futures pricing itself reflects more than just expectations about future prices. It incorporates storage costs, financing rates, convenience yield, and market demand for hedging. This means futures prices can differ significantly from spot prices, creating structures known as contango and backwardation. These concepts matter because they influence roll costs and long-term performance for those who hold futures-based positions over time. Ignoring them leads to confusion and unexpected results. Emotionally, futures trading is demanding. The combination of leverage speed and daily settlement creates intense psychological pressure. Profits feel exhilarating. Losses feel immediate and personal. Without predefined risk limits and position sizing rules, traders are quickly pulled into reactive behavior. Futures do not tolerate hope or hesitation. They reward preparation and punish improvisation. Despite their risks, futures are not inherently speculative toys. They are tools. Used properly, they allow precise exposure, efficient hedging, and capital efficiency, unmatched by most instruments. Used carelessly, they magnify every behavioral flaw an investor possesses. The instrument itself is neutral. The outcome depends entirely on how and why it is used. The most common mistake new participants make is approaching futures with a stock investor's mindset. Stocks allow time. Futures charge rent for it. Stocks can be held indefinitely. Futures expire. Stocks forgive overconfidence slowly. Futures correct it immediately. Understanding this difference is not optional. It is foundational. As futures become more accessible through modern platforms, the temptation to use them without full understanding grows stronger. The real question is no longer what futures are, but when they make sense, how they should be structured, and why most investors are better served respecting their power, rather than testing it casually. Because the line between using futures as a risk management instrument and allowing them to become a source of rapid, irreversible loss is thin. And knowing where that line lies is exactly where we need to go next, by examining when futures contracts serve a clear, disciplined purpose, and when they quietly become accelerators of loss, because with futures, the margin for error is narrow and unforgiving. Futures add value when they are used to hedge defined exposures, gain efficient access to broad markets, or express views with precision while respecting strict risk limits. Hedging fuel costs, interest rate, exposure, currency risk, or equity market beta are rational uses rooted in the original purpose of futures. In these cases, futures are not about making more money, but about losing less in adverse scenarios. Futures begin to work against participants when leverage is treated as opportunity rather than responsibility. The ability to control large notional exposure with small capital creates a false sense of affordability. Positions that look manageable on entry can become overwhelming with modest adverse moves. Without conservative sizing, futures turn volatility into existential risk. Most blow-ups in futures trading are not caused by extreme market events, but by ordinary fluctuations applied to excessive leverage. Risk management is not an add-on in futures trading. It is the core. Predefined stop levels, daily loss limits, and position sizing rules must exist before entry. Futures demand decisiveness. Hesitation and hope are punished by margin calls and forced liquidation. Traders who survive understand that being wrong is normal and acceptable, but being unprepared is not. Time structure is another dividing line. Futures expire, and rolling positions introduces costs and complexity. Long-term exposure through futures requires understanding contango backwardation and roll yield. Ignoring these mechanics leads to results that diverge sharply from expectations. Futures are not buy and hold instruments in the traditional sense. They are tools for active management, even when the underlying view is long-term. Liquidity and market conditions also matter. Futures markets are generally liquid, but liquidity can vanish during stress. Slippage gaps and rapid price moves can overwhelm controls. This is why futures should never be used at the edge of financial capacity. Buffers exist to absorb uncertainty. Removing them invites ruin. Perhaps the most important lesson is that futures are not necessary for most investors. Stocks, bonds, and diversified funds already provide exposure to growth and income with far less complexity. Futures are a specialization suitable for those with clear objectives, robust systems, and emotional resilience. Using them without these prerequisites is not ambition. It is gambling with leverage. In the end, Futures contracts are powerful because they are honest. They expose risk, immediately enforce discipline through daily settlement, and offer no refuge in denial. Used correctly, they can reduce uncertainty and increase efficiency. Used casually, they compress years of mistakes into days of loss. The instrument does not negotiate, it executes. If this discussion helped clarify how futures contracts fit into the broader investment toolkit, consider subscribing to stay with these long-form conversations that prioritize capital preservation over speed, and leave a comment sharing whether you see futures as a hedging tool or a temptation, because understanding that distinction is often what determines survival.